Welcome to Block 101, home of value investing in disruptive innovation and tech. Today I'll be discussing the effects of interest rates and inflation. So when economic variables such as inflation or interest rates change, it's important to be able to assess the likely impact on the entity and its chances of achieving its financial objectives. A change in interest rates might cause an entity's cost of financing to rise and therefore might make it more difficult for that entity to achieve its profit targets, which will ultimately lead to lower valuations due to a drop in investor confidence. Now, changes in interest rates affect the economy in many ways. Three consequences of an increase in interest rates are that 1. Spending falls, 2. Asset values fall, and 3. Inflation falls. Spending falls as expenditure by consumers, both individuals and businesses, are reduced. This occurs because the higher interest rates raise the cost of credit and therefore deter spending. If incomes are fairly stable or fixed in the short term, higher interest rates on credit cards and mortgages, for instance, leave less money available to spend. The fall in spending on consumer goods and services means less aggregate demand in the economy, and as a consequence, unemployment rises. In terms of asset values, the market values of financial assets will drop due to the inverse relationship between bonds and the rate of interest. Now, the most likely reaction is that they will save to try and maintain the value of their existing wealth, which is why you see sell-offs. You saw sell-offs at the end of 2021. And this further reduces expenditure in the economy. Now, in terms of inflation, higher interest rates affect the rate of inflation in three different ways. Number one, less demand in the economy may encourage producers to lower prices in order to sell. Now, throughout 2022, you would have seen a lot of sales on. You would have seen a lot of consumer goods on discount. Number two, new borrowing is deferred due to the higher interest rates and therefore demand falls. And number three, the higher exchange rate will raise export prices, which in turn puts pressure on businesses and producers to cut costs, particularly wages. Now, if workers are laid off, then total demand is reduced and therefore inflation is likely to fall, which is what we have been witnessing of quarter 3 and quarter 4 of 2022. And what we expect to continue witnessing going into 2023, at least until quarter 2, let's say. Now, the effects of inflation. First of all, what is inflation? Inflation is simply rising prices and shows the cost of living in general terms. If the rate of inflation is low, then the effects are beneficial to an economy. People and businesses in particular are encouraged by fairly stable prices and therefore the prospect of higher profits. But in general, if inflation is more than 5%, then it's harmful. And it's even worse if it's accelerating. So in the UK, where I'm currently residing, inflation was above 10%. That's more than double the threshold. So the Prime Minister, Rishi Sunak, and the Chancellor, Jeremy Hunt, have a task on their hands right now, trying to get inflation down. And high inflation is a problem for 6 reasons. Number one, it distorts consumer behavior. Number two, it redistributes income. Number three, it affects wage bargainers. Number four, it undermines business confidence. Number five, it weakens a country's competitive position. Number six, it redistributes wealth. Now, some of those effects are beneficial to some people and harmful to the others. There's winners and losers all around. Now, in terms of distorting consumer behavior, people may be more inclined to bring purchases forward due to the expectation that prices will increase. Now, this can cause hoarding and destabilize markets. Now, in terms of redistributing income, people who are on fixed incomes, such as your average employee that's on a fixed salary and not getting paid commission or any bonuses, or those that lack bargaining power in their role, they will be generally worse off due to their purchasing power falling. Now, in terms of affecting wage bargainers, and affecting wages. Trade unions, on behalf of the workers they represent, will submit higher claims and challenge for better wages. Yeah, we're seeing this currently in the UK. Postal strikes, the NHS strikes, you know, this is what happens during periods of high inflation. And if employers or the government accept these higher claims, this can lead to a wage price spiral, which just increases the problem of inflation. It doesn't improve, it doesn't get better. Now, for undermining business confidence, wide fluctuations in the rate of inflation make it difficult for businesses and entrepreneurs to predict the economic future and accurately calculate prices and return on investment. And this uncertainty handicaps planning and production. You've seen a lot of companies fold because they were planning under different assumptions. The government and banks allowed you to take out debt at these low interest rates or almost zero interest rates, and now they've increased the rate of borrowing, let's say, and repayments to over 5%. And for some companies who weren't expecting it and are overly geared, it's created a problem. It's created a liquidity problem for them. Now, in terms of weakening the country's competitive position, if inflation in a country exceeds the rate of inflation in, say, another country, under the assumption that exchange rates remain unchanged, then it makes exports less attractive and it makes imports more competitive. This therefore leads to fewer sales of a company's products or services at home and abroad and widens the trade deficit. And finally, redistributing wealth. If the rate of interest is below the rate of inflation, then the borrowers are gaining at the expense of lenders. The real value of savings is being eroded, it's being wiped out. Wealth is being redistributed from savers to borrowers and from payables to receivables. As the government is the largest borrower through national debt, the government actually gains the most during times of inflation. Now, you've seen the Fed hovering close to the debt ceiling, and in the UK, the former Chancellor and Liz Truss wanted to increase borrowing with no plan to pay for it. Block 101, Home of Value Investing in Disruptive Innovation and Tech.